This is FRM Part I, Book 1, Foundations of Risk Management, and the chapter on Arbitrage Pricing Theory and Multifactor Models of Risk and Return. To understand the tremendous value that Stephen Ross provides us back in 1976 and his development of the APT model, one has to go back even further in time, back to 1952 and Harry Markowitz, 1964, and William Sharpe with the development of the capital asset pricing model. Now, we just had a really good recording on CAPM, and remember that William Sharpe and others developed this model based on a set of fairly limiting assumptions. These were restrictions about the world in which they operated. I always envision it kind of like the CAPM world is similar to, now this is not a perfect analogy, but similar to all the way back in the very first Star Wars movie. Do you remember Luke Skywalker was in the garbage disposal and the walls were crashing in on him? And so I always think of that CAPM space as kind of a restricted area. Now, it might sound like I'm being critical of CAPM, and oh my gosh, far from it. The amount of knowledge and understanding and wisdom that came from that 1964 capital asset pricing model is tremendous. I mean, it clearly establishes a foundation for us to move on. And that's really what Stephen Ross did in 1976. He was like R2-D2, who I think Luke Skywalker spoke to on some kind of a radio, and R2 moved the walls back out. And so Stephen Ross said, you know what, let's have some room to breathe, and let's try to figure out how we can determine what is a reasonable required rate of return on a share of stock. And so there's Jim's analogy on this chapter here. So some learning objectives. We'll go ahead and explain APT. I've already given it to you about the comparisons to CAPM. We'll talk a little bit more about it. But what really this APT leads to are these multi-factor models. And so we're going to go ahead and spend some good time talking about multi-factor models and how you can use it to hedge. And then we'll look at the Eugene Fama-French three-factor model. And hopefully by the time we get to the end of the slide deck, you'll say to yourself, you know what, Jim, this Fama-French model, this is really, really cool. And I understand how it's based on Stephen Ross, William Sharpe, and Harry Markowitz. All right, so let's go ahead and define APT, a multi-factor asset pricing model, okay? That sounds perfect, right? We need an asset pricing model. What asset are we pricing? We're pricing a share of stock. How are we pricing it? We're trying to figure out what that reasonable required or expected rate of return is. Once again, we're going to base this on a linear relationship because of all the stuff that we talked about in our economics days and in our quantitative methods days when we talk about the relationship between and among variables. So we're going to rely on a linear relationship as well. And then we'll spend a little time talking about systematic risk. And so this is what APT tries to do. It says something like, you know what? There are some variables out there, like, well, let me just pick a couple obvious ones, like inflation, maybe exchange rates, maybe GDP. And those factors capture what is known as systematic risk. Now look at that third block point there, developed as an alternative pricing theory to the capital asset pricing model with fewer assumptions. There's the R2-D2 pushing back on the walls. And I prefer to think of it not so much as an alternative, because that kind of implies that, oh, this is better than the capital asset pricing model, or we didn't like the capital asset pricing model, so we're trying to figure out something else. I always thought of this as a supernatural extension of the capital asset pricing model. And of course, remember that all of these founding fathers of finance, not all of them, but most of them had PhDs in economics because back in the 50s and 60s, there was no really such discipline as finance. And so these were economists. So they relied heavily on their economics training. So this law of one price applies as well to APT that if you have something here and you have something here, and both of these things are identical in every way, and the only difference is that this one trades over there, this one trades over there, well, they have to sell for the same price. Now, let me go ahead and remind you about the capital asset pricing model. This was a single factor model, and that single factor was the market portfolio. It is the market portfolio. And the beta in the capital asset pricing model had lots and lots of pressure on it. What William Sharpe taught us was that beta was so super strong, like Superman. It was so super strong that it could capture all of the variables that are inherent in the macroeconomy. That's a lot of pressure to put on one factor. And so this is what Stephen Ross did. He said, you know what, maybe there are a bunch of factors. Maybe that beta is not strong enough to hold up the bridge of systematic risk and asset pricing. So why don't we just go ahead and add an extra variable or two? And Stephen Ross called them factors. And so look at some of the examples we have. Well, there's inflation, interest rates, productivity, what did I say earlier? Exchange rates. You could throw oil prices in there. You could throw almost anything that relates to the macroeconomic economy. I will say this, that one of the early criticisms of the arbitrage pricing theory was that Stephen Ross never really gave us an idea as to what those factors are. And I don't think that was a very fair criticism. That wasn't his goal. His goal was to say, here, look at things like this, in addition to the capital asset pricing model stuff. And he said to us, look, you guys are smart enough. You figure out what those relevant factors are. Now, let me refer back to the R2-D2 moving the walls away from Luke Skywalker. 3 major assumptions. All right, so systematic factors, which is what we just talked about on that previous slide. But what can happen here is that diversification is going to eliminate that idiosyncratic or that firm-specific risk, much like diversification always does, going back all the way to 1952 and Harry Markowitz. And then the next assumption is that there are no arbitrage opportunities that exist among well-diversified portfolios. And the theory is that, of course, if they existed, then really, really smart men and women out there would immediately take advantage of them. So I love these 2 columns here that we've put in for you. So APT employs multiple factors, so inflation, exchange rates, etc. CAPM is a single factor model. Yeah, the factors used may vary. One day it could be inflation, the next day it could be momentum. CAPM always uses the market portfolio. And one of the criticisms of capital asset pricing model was by a dude named Richard Roll. And he had this thing called Roll's critique. And I remember when I was in graduate school, my professor said something like, look, these criticisms are valid and we need to consider them, but by no means does it make us take the capital asset pricing model and throw it away. APT, no assumption about the empirical distribution of asset returns. Oh boy, so that's super important, because what do lots and lots of the founding fathers, and even throughout the 80s and the 90s, maybe not so much in the 2000s, but we kind of rely on this idea of a normal distribution, which of course is part of the capital asset pricing model assumptions. And this is what we know. We know that that stock returns and asset returns in general do not follow a normal distribution. Now, what that means then is that we have the first moment of the distribution, which is the mean, the second moment of the distribution, which is standard deviation. So capital asset pricing model thinks that those two, first and second moment of the distribution, fully captures the distribution of returns, which it doesn't. And that's why CAPM assumes a quadratic utility function, because in the quadratic form, all you need is the mean and the standard deviation. But this is what we know. We know that there is skewness and there is kurtosis in all different sorts of asset returns. So APT might be better able to predict what the required return on an asset might be better than the capital asset pricing model. Now, this is what I tell my students, I'm going to say this again, is that while asset returns are not normally distributed, they're nearly normally distributed. That's Jim's term. You'll never see that in a chapter or a reading. But oftentimes, it's almost so close to being a normal distribution that the differences are fairly minor. That's why we do things like value at risk and exposure, and we do all these other kinds of ways to quantify risk so that we can capture, those little pockets of non-normal distributions. All right, types of multi-factor models. This is probably a great exam question. So you have the macro factor models, which is what we have been talking about. Then you can look inside of the business. So think of that first one as the macro factor, and the fundamental factor models you could think of as the micro economic factor models. And so these are things like, the size of the business, maybe it's price to cash flow ratio, maybe it's dividend yield, maybe some measure of the quality of the board of directors, if you can quantify that, et cetera, et cetera. And then, of course, there are lots of really smart men and women, and I have a couple of colleagues at school, and they're supply chain people and operations people and econometricians, and they love talking to me about the value of statistical factor models, where you go ahead and you collect a whole bunch of data, and you do machine learning, and you do all this other stuff, and then all of a sudden out pops, oh, hey, there's this factor that only a statistical model could uncover. And then, of course, you have to figure out, all right, does it make any economic sense? I mean, if this statistical factor model came out and said, hey, the number of lantern flies that land on Jim's wife's back porch and drive her crazy, if that is a statistical factor that predicts the returns on, let's say, a company like Johnson & Johnson, well, then we have to scratch our head and say, okay, maybe that's not something that we should use. All right, here's a great equation for those of you who are math oriented. I'm guessing that's most of you. So what I want you to do is I want you to focus, first of all, on the bolded red there right in the middle. And so let me tell you a little bit about what this chapter calls the unexpected return. And so here we have an idea. Let's just pick inflation. So we have an idea for inflation. Let's suppose that it is 4%. And somehow during that time period, whatever that time period was, a month or a quarter or a year, that inflation was, let's say, 5%. So what Stephen Ross is interested is not the 4% and not the 5%, but the difference between the two. Okay, so this is known as the surprise kind of a factor. That's why in parentheses there's an I sub 1 and a 2 and a 3 and a 4 and a 5 all the way out to K, and we subtract that from the expected value of that particular factor. And that should make perfect sense based on all the stuff that we know regarding how you compute something like, let's say, a standard deviation. You want to take the difference between what you thought was going to happen and what actually happened, because then that gives you a sense of, well, how good your model was, or how good your expectations were, or the quality of your ability to process all of that information. And so notice that we're taking a difference inside of those parentheses, and then there's a beta I1 and I2 and I3 and I4 and all the way out to IK. And so those are exactly like the beta from the capital asset pricing model. However, think of them as kind of sub-betas. That beta in the capital asset pricing model had to capture everything. Lots of pressure, didn't I say that earlier? But now we have these compartmentalized betas. There's a beta for inflation. There's a beta for GDP. There's a beta for lantern flies out in Jim's wife's back porch, right? So we can have all of those that are going to give us what the reading calls an unexpected return. Now look out in the, what is that, orange or yellow? It's not yellow. What color is that? How about the Texas Longhorn burnt orange, for those of you football fans out there? So what is that thing out there? We call that an idiosyncratic return. And this thing probably captures some of those dramatic events that occur in the economy. what's the great event that we have had in our recent past? Well, some people might say the spike in inflation in 2022, but we've had spikes in inflation before. But go back a couple of years before that, when COVID hit, clearly that was an unplanned event for the economy. All right, so let's skip back all the way over to the left-hand side of the equal sign. What the chapter calls this thing, the R sub I, is kind of like a revised expected return. It's going to be the difference between what we expected to get, this is the green thing there, what we expected to get versus all those unexpected activities. And so in the green, we expect to get a certain rate of return. Let's just suppose it's 10%. And we expect to get 10% because we think, and I'll just make some numbers up here, we think inflation is going to be 4%. We think GDP is going to grow by 2.8%. We think the US dollar is going to appreciate against world currencies by 4.6%. And we could go all the way out to 100 factors if we wanted to. How about if I throw a silly one in there? My wife expects that there are going to be 75 lanternflies that land on her favorite couch out in the back porch during the course of this quarter. So of course that would be probably something that's not relevant. All right, so here's this model. This is the basis for all of these factor models. And so think about what this adds in value to the capital asset pricing model. It says, all right, look, we love the capital asset pricing model, but let's just divide beta into several components, into several unique factors, because we know that there are some stocks that are more sensitive to inflation than others. There are some stocks that are more sensitive to the value of the dollar than others. There are stocks that are more or less sensitive to all of these other factors. And so this is a beautiful model, and the only way we can understand it is if we spend lots of time on the capital asset pricing model. So let's go ahead and take a look at a super example. This sounds an awful lot like a great exam question here. All right, so look at the factors down the left-hand column. So there's GDP, so there's the size of the economy. There are interest rates, and we don't really know what kind of an interest rate this could be. It could be almost anything, really, but it's some level of interest rate. And then there's inflation. We've talked about that before. So go over to the next column, and there is our beta that is unique to each one of those factors. And then there's the risk premium that is determined based on each of those factors. And so let's just go ahead and make an obvious conclusion here. Look, this portfolio has been assigned a premium of 3% to both GDP and inflation, but notice their sensitivities, their factor loadings, their betas are different. 1.3 for GDP and 0.8 for inflation. And then over on the right two columns, there's the expected GDP versus the actual GDP, which is the same in this case. So we were pretty spot on when we were predicting the size or the change in the economy, right? 5.7 and 5.7. The others, not so much. So let's go ahead and let's figure out what this revised expected return is going to be. So look at that first line, expected return. We're just going to take simple weighted averages here. We'll start with the 2% risk-free rate of interest, and then we'll just add the product of the 1.3 times 3%, the 0.6 times 2%, and that's a minus sign there, right? So make sure you subtract. And then the 0.8 times the 3%. So our expected return is going to be 7.1%. But then we need to figure out what the sensitivities and these factor loadings are regarding the difference between what we thought was going to happen versus what actually happened. And so this is, once again, just a weighted average in there. So we take the beta 1.3 times 5.7 minus 5.7. So that wipes itself out, right? So that's 0. But then we've got 0.6, 2.5 minus the 1. So look, we expected interest rates to be 1, and they were actually 2.5. So we were way off on that, right? And that was a negative sign, so that's going to eat into our portfolio. So what do we get there? What's that? A minus 0.66. And so all we do is take that off of the 7.1. So there's our revised expected return of 644 based on the arbitrage pricing theory, based on our decision to identify just those three factors for our portfolio. So GDP, interest rates, and inflation are relevant for our portfolio. But that portfolio over there, there might be three other factors. So we come up with a whole different matrix and a completely different revised expected return. All right, let's do another example here. Three factors: expected inflation rate, expected 10-year treasury, expected growth in productivity. So we have those, and we have these sensitivities. Notice that we put some in different colors, so you can see the colors up top, and then you can see the colors down below in the mathematics. And so at the year end, we have actual numbers, and so all we're going to do is say something like this. All right, so if the expected return at the beginning of the year was 6%, what is the revised rate of return? So we'll start with that 6%, and then we'll just add the product, the weighted average of those kinds of differences between what we thought was going to happen and what actually happened. So there's our revised estimate, 6.3%. So this example back here and this example here are super identical, but not almost completely identical, but they're very similar. All right, how about another quick one here? This will reduce this one to a single factor model, unexpected percent changes in GDP as the single factor. Look at the table there. We have a 10% expected return. There's our factor beta of 1.5. And so all we really need to do is take that 10% plus the 1.5 times the 4% surprise GDP growth. And so there we get 16%. Now notice that block point down there at the bottom. This is just a reminder of what we learned back in the capital asset pricing model discussion, that a factor loading or a factor beta of 1.5 tells us that we have 50% more sensitivity, 150% sensitivity than just kind of like the regular old market portfolio. Now, among all the cool things about the APT, one of the coolest things is that you can use these factors to hedge. So what do we know from capital asset pricing model and just kind of regular diversification? We know that if we hold well-diversified portfolios, that we can, are you ready for this? We can virtually eliminate unsystematic or that idiosyncratic risk. We learned all that back in the capital asset pricing model. Now, what we also learned is that no matter what you do, you're still going to be exposed to systematic risk. But according to the capital asset pricing model, all investors get to pick their level of systematic risk. You know, if you love risk, what you'll probably do is form a well-diversified portfolio with stocks that have betas of 1.8 and 1.9 and 2.0. Right? If you don't like risk at all, then you'll find stocks that have betas of 0.2 and 0.3 and 0.4. So CAPM teaches us that you cannot diversify systematic risk, but you get to pick your level of systematic risk. It's not like you're totally defenseless, right? But with the arbitrage pricing theory, what you can do is you can use these factor loadings to hedge systematic risk. In fact, the reading goes and it has a good explanation of how you can eliminate systematic risk. So think about this. Suppose that for some reason that I'll just pick a time period. How about January of 2020, right? Isn't that when we first learned about COVID? January of 2020, you had this diversified portfolio, and according to CAPM, your beta was 1.5. But according to APT, you had these different sub-betas. Remember I called them that earlier? And so you had, well, let's just use some of the variables from before, inflation, interest rates, GDP, value of the dollar. So let's suppose you have four factors there. And so remember here, let me go back here just quickly. Let me go back to this here. So here are betas, 1, 3, minus 0.6, and 0.8. So we have those for our 4 factors. But what you can do is you can use those factors and those betas, and you can eliminate systematic risk. And this is what makes financial engineering so cool. We have all these ETFs. So suppose that you had, what did I say? The value of the dollar, and so suppose your beta was 2, and what you could do is you could go out and find an ETF that loads up on all of these high risk stocks, and you could short that ETF, right? And so what you're doing is in your portfolio you have all these high risk, high sensitivity to inflation stocks. You go out and short the ETF of inflation, and you wipe out inflation factor from your portfolio return. So you don't care if inflation goes up or down, because you're going to win in one of those 2 portfolios, right? The long or the short. And so essentially what you can do, look at that second block point. If the goal is to hedge out all the factor risks, you can create a 0 beta portfolio with opposite positions. Now, I'm not saying that this is what you want to do all the time, because of course not. You want to own a well-diversified portfolio so that you can buy low and sell high, so that you can retire early or buy the lake house or whatever it is that investors have as goals. But sometimes, and how about the sometime before COVID and before the spike in inflation in 2022, if we had a 0 beta portfolio, I mean, just think about it. What was the Dow Jones Industrial Average? At the beginning of, let's say, 2022, it was about 35,000, let's say, and in the middle of 2022, it was let's say it was 30,000. I'm rounding there one way or another. So what's that loss? That's about, well, let me do that in my head quickly. Can I do that? That's about 15%, right? And so think about it. You lost 15% during the first 6 or 7 months of 2022. Then you have to hope for a recovery. But let's suppose that we use this APT and these multi-factors, and we hedged against all this stuff. And so our portfolio was still worth 35, through those time periods. Then we can compound on 35 rather than compounding on 30. So this is really, really cool. So you can eliminate risk, but what you can do is you can retain, you can lessen, or you can increase your exposure to certain types of systematic risk. Like right now, if you thought inflation was going to drop to 0, what you could do is you could use this model, and it would identify ETFs out there for you to, let me correct myself. It wouldn't identify specific ETFs. You would have to do that, but it would help you decide, oh, okay, if I want to take advantage of this super reduction in inflation, then I have this factor and its beta. Super cool stuff here. So it makes sense for us to look at some examples here. So let's consider an investor. Portfolio GDP beta of 0.4, consumer sentiment beta of 0.2. So assume the investor wants to hedge GDP factor risk, yet maintain the exposure to consumer sentiment. Well, how do they do this? Well, I just told you this on the previous slide. So we're going to combine the original portfolio with a 40% short position in the GDP factor portfolio. And the easiest way to do this is just to go find an ETF that does this. And so what did I say earlier? What you're doing is you have a portfolio and you have the short position, and they're just canceling each other out. Here, second example is just the opposite. And so what was that consumer sentiment beta up at the top? Was that 0.2? So look at that first circle point there down under case 2. We would short a consumer sentiment factor portfolio, and they would offset each other. How about if we wanted to get rid of both? Well, then we just do 40% invested in the GDP factor portfolio, 20% in the consumer sentiment portfolio, 40% in the risk-free asset. Oh, so what's going to happen here? We're going to combine those original positions with short positions in, what we're calling here on this slide, portfolio H, which is be the hedged portfolio. So this is an illustration of what I was saying before, is that you're essentially forming a zero beta portfolio, which means that you're replicating the return on a treasury security over that time period. Now, before you run away and say, hey, you know what, this is the greatest thing ever, I'm going to go do all this stuff, well, there are probably some things that you need to hold back. Let me go ahead and be like the jockey and kind of hold you back at the beginning of the race. We're in the Kentucky Derby. The jockey, you don't want the horse to expend its energy over the first 3 or 4 furlongs, right? So, what's the problem here? This is why I love talking about marginal costs and marginal benefits. So when you hedge, it's not free. So what we need to do is make sure that the marginal benefit of hedging exceeds the marginal costs of hedging. And look at that second block point here, this hedging strategy. Boy, wouldn't it be great if we could implement the hedging strategy and then just go on vacation and not worry about it? But of course, this is not the way things work in the financial world. What you need to do is you need to continuously monitor and then get some feedback and then try to figure out, okay, what do we do now? Oh, what do we do now that COVID has hit? What do we do now that there's an inflation spike? What do we do now that oil prices are rising? And so there's probably going to be some tracking error. And then you got to decide, all right, what is the limit? What is our acceptable limit of a tracking error? And this has everything to do with marginal costs and marginal benefits. This is the conversation I have with my colleagues at school all the time about model risk. These operations people and supply chain people, they always have these great models. And I always say, suppose it's wrong. And they say, well, we know it's pretty close to being right. And I'm like, okay, I can deal with that. And I'm happy to use that model. But we need to make sure that we're aware of the model risk. And we need to do all of these things, back testing. We need to substitute. We need to do robust tests. I think I said this, 20 minutes ago, a major weakness, and this is what the reading says. I don't know that it's a weakness. I'm not sure this is what Stephen Ross was setting out to do. It's silent on the issue of the appropriate risk factors. And so what Eugene Fama and Ken French did is they came up with this 3-factor model. And so what they've done is they've taken all the stuff that we've looked at, going all the way back to the capital asset pricing model, and they say the following conclusions. They say, all right, look, this is what we know, that smaller firms tend to outperform larger firms for a variety of reasons. And I'll give you a handful of those variety of reasons, one of which is just the simple fact that when we have a large company like Johnson & Johnson, everybody knows about Johnson & Johnson. And so there are lots of analysts that are following Johnson & Johnson. There are lots of analysts that are going to headquarters. There are lots of analysts that are visiting with the people on the supply chain over there and the supply chain over here, talking to the board of directors. So there's very little private information for these larger firms. However, smaller firms don't attract the attention that larger firms do. How about if I'm Jim and I own a concrete company? Jim's Concrete Company, which provides services in the state of Arkansas. All right, so, who knows about Jim's Concrete Company? Well, probably lots of people that live in Arkansas, but maybe nobody else in the whole world knows about it. So you can go ahead and find pockets of maybe not proprietary private information, but information that is not fully reflected in Jim's Concrete Company stock price, which is traded over the counter. And so there's a size factor here, and this is one of the factors that Fama and French put in their model. They also differentiated between growth firms and value firms, and one way to do this is by looking at the price-earnings ratio, but I think quickly the academic world decided that price and earnings are probably not the greatest ratio to look at. So we can look at book value to market value. So remember, book value is the value that shows up on the financial statements. And so what Fama and French learned was that there's a difference between firms that have high book-to-market ratios versus low book-to-market ratios. And so let's go ahead and let's put this in our model so that we can identify the difference and which of those low book-to-market ratios that we want to include and which ones that we want to exclude. And then, of course, they throw in the market portfolio as an acknowledgement to and a validation to William Sharpe and the capital asset pricing model. All right, so here's the slide that I was just describing here. Returns on small firms versus big firms are high, as well as low book-to-market firms. This has been proven through tremendous amounts of academic research. Look at those second and third circle points here. And this is probably important as an underlying economic framework to support this model, that small firms are inherently riskier than big firms, therefore they ought to produce higher returns, but those higher returns somehow are going to reflect that, what did I call it earlier, kind of nearly private information or information that's not well established in the market price out there. High book-to-market firms then are undervalued compared to low book-to-market firms. And so here's the equation. So the expected return on a portfolio, we start with the risk-free rate. We add a beta. Look, there's a beta I1 and a beta I2 and a beta I3, right? So think of it this way. This is Fama-French's way of subdividing William Sharpe's capital asset pricing model beta into three components here. And that's super cool. So let's go ahead and take a look just at a quick example. This is going to be similar to what we've done before. So here we go. Risk-free rate of 1%. There are factor betas. There are the risk premiums. So this is just kind of a weighted average there. You do the math quickly, you get 6.3%. And then this is the application here, is that any return that is different than 6.3 is the alpha of that portfolio. This is probably even more specific to what's known as Jensen's alpha. And that takes us through all of our learning objectives. So what do? We started with Harry Markowitz, then we went to William Sharpe, and now we're in this arbitrage pricing theory. And so I'm hoping that you got all the cool things, all the cool factors that came out of this. So it's clearly worth studying. And this is an area where portfolio managers have really, in the last decade, really kind of concentrated their focus. And this is probably the result of what happened during the 2008 financial crisis when, all stocks fell, but some stocks fell more than others. And then we found out that, some of these stocks fell because of inflation. Some of these stocks fell because of leverage. Some of these stocks fell because of government influence. And so we're trying to figure out all of these factors. So thank you for watching and good luck studying.